Hi everybody, Bo Breskburn here with your LFD Digest for the week of May 18th, 2020. Our first highlight is from a conversation between Tim Mayopoulos and Nate Longfellow. Tim is the president of Blend, which processes $2.5 billion of mortgage applications per day through its bank partners. Nate is head of digital product strategy and change delivery for home lending at Wells Fargo. Let's hear how Nate characterizes the standard mortgage banking approach that a typical bank might take toward its customers.
There's a pattern that we have in this industry where we spend a lot of time originating the mortgage with our customer, finding the lead, engaging with them, having great conversations and guiding them through that process. And then we, typically traditionally pass them over to a servicing experience where we say, now go make your payments. And honestly, we probably try to say, don't talk to me that much because every time you call me, it costs us money. And then we kind of scratch our head 5 years later when they don't stay with us. I think historically, the way banks have faced off with customers is by providing them a menu of products and services. And what they're really saying but not saying when they have that is, I don't know enough about what you're going through, customer, in your life, but here's some products and services. I hope you figure it out.
Now, here's how Nate feels Wells is changing the way they view the customer relationship and how that plays out in the data architecture and adaptable modeling inside Wells Fargo.
We do view the customer relationship as a perpetual relationship, and their data is persistent and changes constantly as well. So we look at it as we were starting to move into a world where we're decisioning our customers before they're even ready to transact. And some of the words that we're using internally are that we're going to build capabilities to be ready to lend when the customer is ready to transact. And part of that is a pretty comprehensive set of capabilities. It's really about knowing the customer and their data, knowing investor guidelines and rules in that data, and setting a model that allows it to constantly change. And that's what's a fact within the real estate transaction is data will change. And our systems and our intelligence needs to be smart enough to adapt to that change.
And here's the zinger from Nate.
When he said, nobody really wants a mortgage. They want a home.
Thank you, Tim and Nate, for sharing your experience in mortgage lending. For more, check out their full talk on LFD Replays. Next, we move on to Mindy Hauptman of Boston Consulting Group, who shared with us BCG's fresh results from their banking survey. Here's Mindy explaining the off-the-charts customer sat rating that digital experiences are receiving today.
So over 90% of the people who have used digital channels during this time have said that they've been satisfied with the experience, which is higher than with any other channel.
Now, in terms of digital discovery, customers fall into several segments.
About a quarter of the people started using it for what I would call positive reasons. People who said things like, I always wanted to do this, I just never had the opportunity.
That number matches the percentage of people that claim they will stop going to branches.
Globally, almost a quarter of people told us that they will stop going to branches as frequently or maybe stop going completely.
Now compare our situation today to that of the GFC of 2008-2009, and public sentiment about banks is materially different.
In pretty much every country, there's been a net increase in the amount that consumers say that they trust their bank. We are seeing just an overall flight to safety, and deposits at banks, especially large banks, have skyrocketed during this period.
And here's the zinger. Which entities have the better digital experience?
The big banks have mobile app ratings that are every bit as good as the digital banks. So I don't think this is a question of traditional bank versus digital bank. I think this becomes more of a question of big banks versus small banks. I think that these findings should be very worrisome to community banks.
Now, I challenged Mindy on this and said, look, let's not talk about big versus small. Let's reframe it as resourced and agile versus under-resourced and ossified. There are plenty of banks, big and small, that fit either description. And I'm not at all concerned about community banks. I think community banks have really shown in the past 8 weeks. Look no further than Sunrise, which appeared on LFD last week. But still, her point is well taken and echoed by our next guest, Ron Shevlin, Director of Research for Cornerstone Advisors.
So the idea that the large banks are behind on mobile banking is wrong. The reality is that what the challenger banks have been doing over the past couple of years is capturing consumers who are not switching. They are not closing out their accounts with their primary banks. They're opening up what I like to call accessory accounts because they want better PFM features, or they want higher interest rates, or they want those debit card rewards. And because the business model for the challenger banks has been so weak, they've mostly been focusing on trying to drive payment volume. A lot of folks are saying that the crisis has been accelerating the digital transformation of the banks. I think the crisis is accelerating the destruction or the downfall of the challenger banks, things that I think were inevitable anyway, unless they shifted business models.
Ron was a great guest. He's got a sharp toolkit, and he brought his full set of wrenches to this discussion. In summary of his thesis, Ron talked about 3 points of resistance that tend to occur inside a bank and that tend to demote rather than promote a bank's technological adaptation and advancement.
Generally speaking, there are 3 limitations that face fintech: policy decisions, consumer behavior, trends, and the forces that make us want to not change our behavior. And the third is management mentality. Those, especially those who continue to believe the branch is important. When we get over those things, then there's no, nothing holding back fintech when you get past those 3 points of resistance.
Next, we moved on to a distinguished panel of VC investors: Maria Gotsch of the Partnership Fund for New York City, Chris Sugden of Edison Partners, and Phin Upham of Haymaker Capital. This session was moderated by Chris Moller of Deloitte. Here's Phin and Maria setting the stage for a shift we're experiencing in this moment in venture capital.
And I think we've all seen so many excesses and sloppiness and grandiose visions of fintech. I think it's going to be very, very interesting to see how things sort of come back to the core beliefs and the core value adds of the sector, and what that means for partnerships with incumbents, what that means for growth, what that means for funding, what that means for profitability.
I agree with Phin. There always are gaps. Anytime a crisis happens, that's sort of, it's like an earthquake. The earth opens up and there's some interesting things that come out. And so you tend to fall back on the people the networks you have. And so for companies, I think that's why you see a lot of insider rounds, or if you've had meetings with people in the venture community as an entrepreneur before the shutdown happened, those are the ones you should focus on, because there is something about the person to person which investors, particularly for the early stages, find important.
Now here's Chris Sugden applying what he learned about B2B sales during the GFC.
Growth, you think you got product market fit until times like this, right? And that's the growth companies are finding out. And if I go back to some GFC learnings, that the 08s, 9s, 10s time, what we saw in B2B, because Phin's right, B2B is always there in quotes until they're not, or until it takes a lot longer to close deals. So what we found back then was your sort of ROI was no longer a soft calculation and, it's 12 months-ish. Right. It was like a 3-month to 6-month kind of window in that time. And you're seeing that now in the pipeline, sort of what's closing, what's not, what's getting stretched out.
So if the sales cycle is stretched to 3x its normal length, what's the first thing we need to do? Here's Maria.
Just look at the pitch deck of your products. And if your pitch deck spends 4 pages talking about the technology before you talk about the problem you're solving for your customer, this is for B2B, you need to rip up that deck and start again. Because
now here's Chris on the challenge we're facing with fairly green sales leaders.
Some companies who have younger sales forces, younger sales leader, haven't seen this movie, right? You're literally 12 years out from the last time people faced this reality, maybe 10. Where were your VPs of sales then? They were selling, or they weren't even in a senior management position at all. So sort of bringing some of the gray hair to the table and sort of explaining what happens when you have multiple buyers, it's sort of a wake-up call, because things were moving so fast, right? We were in a great economy. Things were cranking. There's sort of this, oh my God, come to Jesus moment.
And here's Chris again talking about how far down they wrote down their sales expectations across the board. And that was in the good scenario.
So Q2, 25% of what you were going to do of your current plan. That was one guide. Q3, somewhere between 40 and 50%, and Q4, 75%. That's where we stuck a sort of a stake in the ground. We'll see if we're right. It's just no idea if we'll be right, but you start somewhere. Then we force from there, even worst case, to figure out where they're going to run out of money.
In closing, Maria proposes an idea that she hopes many entrepreneurs are riffing on right now. A new product or service that hasn't been necessary until today, but boy, is it needed now.
The need for an entire class of people whose businesses have been wiped out, who may or may not be coming back, to come up with products and resources that can help those people and those businesses get back into shape in a way that makes them viable.
Now, in this episode of the LFD Digest, I cut out huge swaths of amazing content to get it in under the 10-minute mark, and I'm not sure I succeeded. To do that, I put none of Ron Suber's Open Roundtable and almost none of the brilliant statements of Phin Upham. To get your dose of those two gents, you'll need to tune into our LFD Spotlights on Ron and Phin, which we are going to publish alongside this digest. Until next time, keep up the hard work and take care.